Assalamu alaikum dear students. So we will start our today lecture, and today our topic is money market segments. Before that we studied that what is the money markets, then we studied the features and functions of the money market. So today our topic is money market segments. I will just repeat that what does it mean by money market. So money market is that financial market where the short-term securities trading are taken place. So that financial market is called money markets. Here the lending and borrowing of such type of the security which have the maturity less than 1 year that are trading. So that market is called money market. What are the main, or we can say that the segments of the money markets? So following, as you know on your screen, these are the segments of the money markets: interbank markets, primary markets, secondary markets, and derivatives market. So one by one we are now going to discuss. Interbank market. So interbank market, dear students, and these are refers to the modern day financial system, and this market involves the bank trading cash and other instruments with other financial institutions and banks. This never involves banks trading money with non-financial businesses, consumer, or the retail investors. It is possible for the interbank trading to be pursued by banks for the benefits of their customers. But in general, such trading between banks prove to be properly, and this means that it happens between banks on the behalf of their own company accounts. So interbank market, where the banks and non-deposit financial institutions, they settle a contract with each other, and as well as with the central banks in case of lending and borrowing. So this type of the money market is called interbank market. Dear students, furthermore, interbank markets that are involved in the foreign exchange services, in the commercial capacity of buying and selling of currency. There can be long-term trading as well as a huge quantity of the short terms. So the Bank of International Settlement stated in the informations that included the banks and other non-deposit financial institutions transactions. So all these comes in the interbank transaction. Second one is now the segment of the money market, that is primary market. So primary market is a market where for the first time the securities that are issuing, such market is called primary market, as its name indicates. So primary markets, this is a part of the capital market as well as of the money market, that deals with the issuing and the sales of the securities or backed securities to the investors directly by the issuers. Investor buy security or purchase the security that were never traded before. And it means that for the first time, when the security that is issued by issuer, primary markets that create the short terms and as well as the long terms instruments through which a corporate entity raise their funds from the markets. Dear students, the primary markets, we can in simple words we say that where the securities are created, it's in this markets that all those firms sell, or we can say that float new stock, and that are offered for the sales. So an initial public offering, or that is IPO, is an example of a primary markets. Second one is secondary market. So secondary market is a market where investor buy and sells all the securities that are already issued in the primary market. So that market is called secondary market. It is what most people typically think of is the stock market. So those stocks are also sold in the primary market when they are first issued, and after that, when they are issuing in again and again, the trading of the security taken place again and again or repeatedly. So that market is called what? That is called secondary market. Secondary market, that is also called after market or follow on public offering. That is the financial market in which previously issued, already issued financial instruments such as the commercial paper, certificates of deposit, etc., that are already issued. So that market, that is called what? That is called secondary markets. The term secondary market is also used to refer to the market for any used financial assets or alternative use of the existing assets. Clear? Where the customer base is the second markets. For example, I will give you a simple example. A corn that has been traditionally used primarily for the food productions for the feedstocks, but a second or third market that has developed for the use in ethanol productions. So then that will be called the secondary. So with the primary issuance of securities or financial instruments or the primary markets, so the investor purchase these securities directly from the issuers. Clear? Like such as the corporations, they are issuing shares in an IPO, initial public offering, or private placements, or directly from the governments in case of the government issuing treasury, like treasury bills, etc. So after the initial issuing, the investors, when they can purchase from other investors maybe in the same market, so then that is called what? That is called secondary market. Look at, if there is an ABC company, and for the first time when they newly issued the stock, the securities, the stock, and you people buy it directly from the issuer company. So this, now in which market this transaction took place, that market is called secondary market. and look again the market price is increased or decreased, whatever happened, but you sold out those security to me. So in which market you sold out? That is called what? Secondary market. Now I sold out to another one person, another one person sold out to another one person. So then this market will be called, that is called secondary market. Clear now? So the secondary market for the variety of the assets can vary from the stock to stocks. The next one is derivative market. Derivative market is the financial market for the derivatives, financial instrument like future contracts or options which are derived from the other form of the assets. The market that can be divided into main two types, that for the exchange traded derivatives and for the over the counter derivatives. One will be taken place in the organized market and one will be taken place in the non-organized market or in the OTC market. Simply, derivative market is that markets where the transaction will be taken place in future, but contracts for such type of the transaction are fixed in the today. So this type of the market, that is called derivative market. Look at, for example, simply we are engaged in a transaction. There is A and B. Mr. A thinks that in the upcoming 2 or 3 months, the dollar rate against Afghani, that will be reached to 80. But B says that no, rate will not be increased up to 80. It will stuck between 77 to 77.50 within 3 months. So now what they say, A told to B that we are going to make a contract. Clear? Now I want to get a credit purchases from you, and I will make the payments of those credit purchases with the exchange rate of 79. Contract the $1 lakh, let's suppose, but exchange rate is 79 that are fixed. Today current rate is, let's suppose, that is 77. After 3 months, when the maturity comes, so the dollar rate was increased to 80. Now A will make payments to B on 78 exchange rate. Why? They make a contract on 78. So in this case, A are in the profit. But let's suppose if the exchange rate dropped 76. Now in this case, A are in the loss and B are in the profit. Why? A is now make the payments of the exchange of the dollar with us, which is in the market is 76, but they are now make the payments on 79. So when this type of the contracts taken place in a market, such market is called derivative market. In detail we will discuss in our upcoming classes, but I will give you now a short explanation further that derivative markets, they have four participants: hedgers, speculators, arbitrageurs, and traders, or that is also called margin traders. These are called the participants of the derivative markets. What is hedger now? Yeah, hedging, you have here the word hedging. So hedgers are hedging when a person invests in a financial market to reduce the risk of the price volatility, price changing in the exchange market. So that eliminate the risk of the future price movement. So derivative are the most popular instruments in the sphere of hedging. It is because that derivatives are effective hedges in the correspondence with the respective underlying assets. Hedger, like, look at why I am accepting, like if today the dollar exchange rate is 77 and we are going to make in the credit transaction, and you are saying to me, yeah, let's suppose I am saying to you that I will make a payments, today is 77 rate, but after 3 months I will make a payment on $77.10. So why? Because I feel that the prices will be fluctuate. There will be volatility in the price. So I want to give safeguards to myself. So this person is called hedger, who want to safeguard themselves against the future exchange rate volatility. And this transaction is called hedging transactions. Clear? Second one is speculators. Speculators are speculation, that is, here risk is involved, is the most common market activity that participants of the financial market take part in it. It is a risky activity that an investors that are engaged in it. It involves the purchase of any financial instruments of or assets that an investor speculates to become significantly valuable in the future. So speculation is driven by motive of potentially earning profit, more profit in futures. So speculators, when they make investments in the security, so in the things that yes, there is chances that in the future the prices will be reduced, or the prices, market prices will be increased, but still on the positive thinking they have, so they are in the thinking that we will get more profit, so that's why they are taking too much high risk and make investments. Third one is arbitrageurs. So arbitrageurs, arbitrage is a very common profit that is making activity in the financial markets or in the derivative markets that comes into the effects by taking the advantages of a profiting from the price volatility market. How? Arbitrageurs make a profit from the price differences arises in the investments of the financial instruments. Like if they are purchasing the financial asset in one market and at a low price and sold out in it to another one market at a higher price, but he in advance know, the arbitrager in advance know the market price of both the market price. So from that market where the price, the instrument's price are less, so they are engaged in a contract with a lower price buy it, clear, and sold out it to another one market at a higher price, and they are getting profit in this case, clear. Fourth one, the participants of the derivative market, that is the margin traders. So in the finance industry, the margin is the collateral deposits by an investors investing in financial instruments to the counterparty to cover the credit risk associated with the investments. That is called margins or margin traders. So as we discussed that in the derivative markets, the parties are involved in the future in the contracts. So these contracts may be on, that is of the different natures. So these contracts are called option contracts, future contracts, forward contracts, and swap contracts. What is now the option or options contracts in the derivative markets? So options are the financial derivatives contracts that gives the buyer the right but not the obligations to buy or sell an underlying assets at a specific price. That is also called strike price. Similarly, in future contracts, so future contracts are standardized contracts that allow the holders of the contracts to buy or sell the respective underlying assets at an agreed price at a specific date. So the parties that are involved in the future contracts not only possess the right but also are under the obligations to carry out the contracts as agreed. And this is a standardized contract, so third party that are involved, financial institutions, that third parties that will be involved, and that is a third party, maybe we can say that yes, that is a clearing house. Yes, so clearing house says they are offering these type of the contracts, and neither in this contracts the buyer and neither the seller have the right to demolish the contracts. And the contracts are standardized, they are traded on the exchange markets. Forward contracts of the derivative market. So forward contracts are similar to the future contracts in the sense that the holder of the contract possesses not only the right but also under the obligations to carry out all the contracts. However, the forward contracts, dear students, are over the counters in anywhere that can be taken place, but future contracts is standardized, keep in mind. So which means that they are not regulated, in forward contracts are not properly regulated and are not bound by the specific trading rules and regulations. So these contracts are risky as compared to future contracts. Anytime the buyer and seller, they can withdraw from the contracts. Clear? In detail we will discuss these in the upcoming lecture, but just I am going you the short overview. Swapping contracts. Swaps. Swaps are the derivative contracts of the derivative markets that involves two holders or two parties to the contracts to exchange the financial obligations. Interest rate swap are the most common swaps contracts entered into by the investors. So dear students, swaps are not traded on the exchange market. They are traded over the counter in the OTC market anywhere in no proper organized market that is required for the swap. No, never. Because of the need of the swap contracts to be customizable to suit the needs and the requirements of both the parties that are involved. So that's why both the parties, they comes in the OTC markets and enters in the contracts. So I hope that you will understand the segments of the money markets. So in my upcoming lecture, we will discuss the types of the financial market with respect to nature, that what is the natures of the types of the financial assets. Clear? So we'll see you inshallah in the next class. For now, Allah Hafiz, have a good time.